What's up guys? In this video, we're gonna go over how to make money in a stock market crash. Now I got the idea for this video when I was scrolling through YouTube and I've seen a ton of new videos on the upcoming stock market crash. And that got me thinking because I know a lot of successful investors look forward to a stock market crash because they like to buy low and sell high. But no. In this video, we're gonna look at how to buy high and sell low. Now let's jump into it. Making money when the stock market falls is actually nothing new. If you've ever seen the movie The Big Short, the main character, Michael Burry, makes millions of dollars correctly predicting the stock market crash. After doing some research in this area, I want to focus on two strategies that you can make money betting against the stock market. The first being buying put options, and the second being buying inverse ETFs. But before we get into it, please go down and hit the like button below. It'll really help out this video. And if you're not already subscribed to my channel, please consider subscribing. That way you get notifications for future videos. The first strategy that we're going to go over is buying put options. Let me just explain what an option is. That way everyone can follow along with this video. Basically, options are a contract that you buy that give you the option to buy or sell 100 shares of a stock at a predetermined price by a specified date. When you buy call options, you're betting that the stock price is going to go up, and when you buy put options, you're betting that the stock price is going to go down. So for example, just like the Tesla that Elon Musk set into space, what goes up must come down. And we think that Tesla's stock price is just way too high right now. So what we can do is buy a put option on Tesla. The price that we pay is going to be determined by the expiration date and the strike price. The strike price is what we have the option to sell Tesla's stock at. Let's say that we pick the expiration date of February 26th and the strike price at $860. Then by our expiration date, for every dollar that Tesla is below $860, we make $100. And we don't have to wait for our expiration date to sell the contract. And let's say by our expiration date that Tesla is actually above our strike price, then we can just let our contract expire and we'll just lose what we paid for the contract. This is a way to leverage our money because buying one contract worth 100 shares is far less than buying 100 shares of the company itself. But you might be wondering what are the cons of this strategy. So just to name a few, back when we were looking at the options contract, you might have noticed something that said break-even price. That's the price that the stock needs to fall to so that we can start making money. Also, the price that you see for the contract is for one share. So you have to multiply that price by 100, which can definitely get really expensive. But it's still not as expensive as buying 100 shares of the actual stock. And probably the biggest setback to this whole strategy is the expiration date. Since these contracts don't last forever, we have to predict when the stock market crash will happen, which can be incredibly hard. But I don't know. I personally don't think I'm smart enough to predict the stock market crash, but who knows? Maybe you guys are some geniuses, big brain level energy. And let me know, do you think you'd be able to predict the stock market crash? Do you know when the stock market's gonna crash? Let me know in the comment section below. So the second strategy that we're gonna go over is inverse ETFs. And if you're not super familiar with inverse ETFs, I'm sure you're not the only one, and I'm about to break it down. So just to break this down step by step, an ETF tracks an index like the S&P 500, and it's a collection of stocks. So for example, let's say that we're looking at SPY, which tracks the S&P 500 index, and the S&P 500 one day goes down by 5%. We should also see SPY going down by 5%. But we also have inverse ETFs such as SH that track the S&P 500, but in this case, it'll try to give the opposite return day by day for the S&P 500. So let's take our original example where the S&P 500 and SPY went down by 5%, then SH will go up by 5% that day. So now we're going to jump over to my computer where we can see a real world example of the difference between an ETF that tracks the S&P 500 and an inverse ETF that tracks the S&P 500. Where SPY today on February 26th went down by 0.52% today. And if we look at the inverse ETF, SH, it went up by 0.51% today. And looking at both of these returns side by side, we can see that they made roughly the opposite returns of each other today. So we can see that SH has roughly a 1-to-1 relation with SPY and the S&P 500 on a day-to-day basis. But there's also leveraged inverse ETFs out there where if SPY were to go down by 5%, a triple leveraged inverse ETF that tracks the S&P 500 would go up by 15% in one day, which is just crazy. Let's take a look at another example where again today SPY went down by 0.52% today. And if we look at SPXU, which is a triple leveraged inverse ETF of the S&P 500, where it went up by 1.63% today, which is roughly 3 times the inverse of SPY. But this can also be very risky because the opposite is also true. So just like I did with put options, I want to go over some of the problems with inverse ETFs because I think both of these strategies are actually pretty risky, and I don't want anybody getting the wrong idea thinking that these are strategies that can never fail. I'm covering both these topics for entertainment purposes only, and I just thought it was cool that you can make money from the stock market crash itself. So the first thing that I want to mention is that when I told you the definition of an inverse ETF, I said that they're only tracking the inverse on a day-to-day basis. So if we're looking at the inverse ETF, SH, which has roughly a 1-to-1 ratio with SPY on a day-to-day basis, over the past year, while SPY has gone up 27.85%, SH has actually gone down by 32.15%. So that 1-to-1 ratio between SPY and SH is only on a day-to-day basis. So because of this, inverse ETFs are really only meant for short-term trades, and they're actually really popular with day traders. They also have really high fees when you compare them to the average ETFs out there. Most ETFs have an expense ratio of around 0.1%, whereas inverse ETFs have an expense ratio around 1% on average. So this is actually a pretty significant difference. So just to sum it up, with both put options and inverse ETFs, it really just comes down to if you're able to successfully predict the stock market crash, because time is not on our side. But you already know, I couldn't make this video without putting a few Benjamins on the line. Hopefully these YouTubers are right and the stock market crash is coming up. In that case, I'll be walking away with the bag and maybe even make it on the top page of Wall Street's bets. So there you have it. These are definitely some risky investments, but with a little luck, or if you're just good at predicting a crash, you can turn a small investment into a huge fortune. But I hope you guys enjoyed this video. Thank you guys so much again for watching, and I hope you guys have a blessed rest of your day. Peace.